Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, comment on this podcast, and find links and other information related to today's conversation. You'll also find our archives where you can listen to every episode we've ever done going back to 2006. Our email address is mail@econtalk.org. We'd love to hear from you. Today is March 20th, 2017, and my guest is author, journalist, and commentator Rana Foroohar. She is a columnist at the Financial Times and the author of Makers and Takers, The Rise of Finance and the Fall of American Business, which is the subject of our conversation today. Rana, welcome to EconTalk.
Thank you so much for having me, Russ.
So I want to start with the rise of the financial sector, which is one of the themes of your book, and I want to start with a quote. You say, how did finance, a sector that makes up 7% of the economy and creates only 4% of the jobs, of all jobs, come to generate almost a third of all corporate profits in America at the height of the housing boom, up from some 10% of the slice it was taking 25 years ago? So why is this alarming, and what does it tell us?
Well, I would start by saying the financial sector or financial services, and I stress the word services because that's kind of the key point here. Finance used to be in service to the real economy, in service to business. It used to function basically as an intermediary, greasing the wheels of Main Street capitalism. But what I'm arguing in this book is over the last 40 years or so, we've had a fundamental shift in two ways. In the role of the financial services sector in our economy has now become sort of the tail that wags the dog, which I can explain a little bit more about, but also in terms of size. So those numbers that you quoted before, 7% of GDP, 4% of jobs, but a quarter of all corporate profits, that is a big, big shift. If you go back to the 1970s, finance was about half the size in terms of U.S. GDP as it is today. It was playing much more of a sort of capital allocation role rather than a trading role. So it was essentially helping do what Adam Smith thought it should do, which is take all of our savings in the form of bank deposits and lend them out to Main Street businesses, to the real economy, which would then create growth and jobs. I'm arguing that today the financial services sector, and I have a lot of deep research in the book to back this up, has become the game in and of itself. Only about 15% of all the capital coming out of the biggest U.S. financial institutions today goes into business, goes on to Main Street. The rest of it is basically about the buying and selling of existing assets, which brews bubbles, which creates instability in the system, and also creates a kind of a perverse cycle in many ways, in many deep ways, where we are all oriented towards the financial markets, via our 401ks, or if you're a CEO trying to jack up the share price of a company. It's all about pleasing the markets. It's all about the short term. And I'm arguing that that's had a very deep and degrading effect on the real economy in America.
So only 15%, you suggest, goes to, quote, real projects or real investment rather than moving stuff around, pieces of paper, speculation, trading, and so on. Of course, it's much bigger than it used to be. So 15% of a much bigger number could still be a good number. The real question that I worry about, and I think you worry about also, is the rest of it. What is going on there? And the industry would defend itself by saying that they have created all these new instruments, derivatives and other things, that, yes, sometimes blow up, but are useful in helping people create the portfolio that best matches their risk preferences. Sure. How do you respond? That's the argument. They've got to tell a story. What, right? I mean, that's
we've all got our narrative, right?
Right. So, what's wrong with that narrative? Do you think it's there's some truth to it, or do you find it just self-serving?
Sure. So let me take that in pieces. Let me first go to this 15%, which is an important number. This, by the way, is based on very deep, long-term academic research that was done by Alan Taylor, who used to be with Morgan Stanley, now at Berkeley, and Maurice Schullerich, who is a European academic. It was funded by INET, which is the Institute for New Economic Thinking, which is kind of, as you probably know, a liberal leaning think tank that's dedicated to kind of getting new economic ideas out there. And basically what they're looking at is the amount of investment that goes into business, into real businesses that create real products. And that's only 15% now. And yes, that's true that it is a much larger number than it was in the 70s. But to your point, what's the rest of it doing? Well, that 85% that's left over is the trading of existing assets, stocks, bonds, and housing. And there is a lot of research from big institutions, the BIS, the IMF, the World Bank, any number of academics that show that all of that trading has questionable economic value on a kind of a global net basis. It certainly has not generated real economic growth. If you look at the growth of finance, you find that it tends to stifle economies when it's even half the size that it is in the U.S. right now. On the other hand, there's also a lot of research to show that excess trading creates bubbles, creates market volatility. I mean, there's plenty of academic research I can cite, but we can also just go back to our own memories of 2008, and we sort of know how this works. But to your point about derivatives and risk allocation, this is a really, really interesting question. And in fact, one of my favorite chapters in my book is a chapter that looks at this very question. I have a chapter on derivatives trading, and in particular commodities and derivatives trading. And I spoke to some great sources on this. Gary Gensler, who used to be head of the CFTC, was a big source on that chapter. And I looked at the story that I'm sure many listeners will remember from a few years back about the run-up in aluminum prices globally. There was a wonderful front page story on the New York Times that I think really encapsulated it for a lot of people, looking at how Goldman Sachs had become a large owner of aluminum and was getting around loopholes about the fact that you can't sit on a lot of raw commodities and trade them at the same time. You have to kind of move them out of warehouses. The idea is that this prevents banks like Goldman from actually owning and trading and thus, cornering or manipulating the market in certain raw commodities. Well, the bank was getting around this by literally kind of forklifting aluminum from one warehouse and moving it, 16 feet to the other one. And it was just a really wonderful visual of how perverted the entire market in this particular area of commodities, derivatives, trading and ownership had become. And, there are numbers that show that, yes, of course, derivatives trading is useful for people that own raw commodities, people like farmers, and derivatives have been used since ancient Greek times. The idea of an option on an olive oil press was something that was talked about way back when. That's all well and good. But the problem is that today, the derivatives market itself is an exponential factor larger than the value of the underlying commodities that it's supposed to be insuring against. So many people, many academics, which I quote heavily in this chapter, would say, look, when you've got a market in trading that is, I couldn't say what it is at this very moment, but 25, 30, 50 times the value of the underlying product that is being insured, something's going on that has nothing to do with the real economy. And there have been any number of traders that I've spoken to that say the same thing, that look, hedging is a business. It is no longer necessarily or in large part about actually protecting the value of an underlying commodity. It's about making a profit. And one of the things that is particularly tricky, and I know I'm getting a little into the weeds here, but I think it's useful for people to understand. There used to be legislation that protected consumers in the marketplace from market manipulation, in the sense that someone who was doing a lot of trading or primarily being a trader and a market maker couldn't actually own a lot of physical commodities. That has now changed. Banks lobbied against that rule many years ago. And so now you have huge institutions that can both own a physical commodity and trade it for profit, which is kind of the essence of market manipulation. And that's why this chapter looks at how companies like Coke and Coors and the people that actually need aluminum to make their products were complaining that, hey, why is Goldman Sachs manipulating and cornering the market in this product? By the way, I should say that this whole incident was looked into by regulators, and the bank was not found guilty of any misdoing. But again, experts would say it's very, very difficult to tease out what is about hedging your portfolio for legitimate reasons and what is about speculation and market manipulation. And I think anybody who takes a look at this chapter will be surprised, to see how close those two things can be.
I wasn't convinced by it. I thought it was interesting. I hadn't followed the incident and the discussion when it happened in real time. And I think, you raised a lot of points. There was a lot of interesting thoughts there. One of them is the size of the derivative market relative to the underlying product. It sounds bad. It's weird. But I think the fundamental issue is, what are the incentives and how competitive are these markets? And of course, some of them are not so competitive. We're going to come to that later when we talk about regulation and the size of the banking, the concentration in the banking sector. I want to talk about that later. But I think in this particular case, I looked at the data. We'll put up links to that New York Times story and some subsequent analyses. It looks to me like aluminum actually fell. The price of aluminum fell during a large part of this claim when Goldman was manipulating the market. And listeners of the program know I'm not a big fan of Goldman Sachs, so it's not a for me, I wish it were. Part of me wishes it were otherwise, and obviously reasonable people can disagree on this. But I think the fundamental question is competitiveness. How many firms can get access to this, and the stupidity of making firms move stuff around a forklifts. That's we probably agree on that.
Well, it's interesting. Let me jump in and say, for starters, it's really important on the aluminum question. And I quoted Michael Masters, who himself was a trader, was one of the people that came out and said, hey, it's not right what's happening in the derivatives market. And he had Senate testimony that you might want to link to as well, which is fascinating.
Sure.
But one of the reasons that Goldman and the other banks got out of aluminum is that, guess what? It was a good time to get out of aluminum for a couple of reasons. One, the hot money that had come into the emerging markets and the commodities markets, which often are a play on the emerging markets. And that had come, by the way, PS, because of the Fed pumping $4 trillion of money into markets thanks to the financial crisis. We can talk about that and financialization as well. But they got out of the aluminum market in part because that bubble was peaking and starting to decline. And the Fed had also announced that it was going to start looking at this rule about whether traders could actually own physical commodities. And so it was a good time to get out. But per your point about regulation, there's still nothing that would prevent a bank, a financial entity, from getting back into these markets, bidding them up, and doing things that are actually a bigger deal than just making the price of a six-pack more expensive. Doing things like making it hard for people to eat. Josette Sharon, who was the head of the World Food Program during the commodities run-up that I write about in my book, when it used to go around Davos with a red cup that held a day's worth of grain for kids that she was feeding through the World Food Program. And she said, she would pour out half of it and say, that's how much speculators are literally taking out of the mouths of children. So I got to push back and say, I think that speculation is a huge deal in commodities. And even if we are now not at the top of a cycle, it doesn't mean that we can't be back there again. But let's talk about regulation, because I think that's another interesting topic. I
just think speculation is the world's a complicated place, and the opportunity, as you point out, to hedge against future uncertainty has been comforting to a lot of farmers and a lot of folks.
Worry they should be allowed to do that, but I think that we need to have a rule come back onto the books that institutions that are primarily trading should not be owning large amounts of physical commodities. But anyway, that's, we can
that's okay.
Move on if you'd like.
Yeah, no, let's move on. The bigger issue, you alluded to the fact that the size of that there have been some studies that suggest that the size of the financial sector it's too big in terms of growth. And you talk in your book about how the financial sector reduces growth, the size of it. And I've seen equally general studies, and these kind of studies are inevitably, I don't trust any of them actually, that have shown that the bigger the financial sector, the bigger the growth. And these are just, I think this is kind of a bad exercise. I think the question is, what are the incentives that the financial sector faces that are healthy and what are unhealthy? And I think those are the issues. So let's take one of the ones that comes up in your book, the lack of investment that's going on in the American economy today, the stockpiling of cash, the use of that cash for stock buybacks. So you're alarmed by that. I am too, but I think for a different reason. So talk about what's worrisome to you about it.
Okay, so this is a really complicated issue. There's sort of two things in play. There's the size of the financial sector and how it's grown over the last 40 years. And by the way, let me caveat by saying that there have been many periods over several hundred years of the growth and the diminishment of the financial sector. So I kind of took the most recent one because it's just the easiest window to look at, but this has all happened before. So there's that. And then there's, what is the role of the corporation? Is the role of the corporation to simply please the shareholder? The kind of current debate over shareholder value and whether the stock price of a company is the best indicator of its underlying value. Or is the role of the company something else? Is it to please a larger group of stakeholders, not just shareholders, but workers, consumers, the community at large, regional economic ecosystems? And I would say that, in the U.S., of course, we have basically shareholder capitalism, which a lot of people, even within the financial sector, are starting to push back about. But in other countries and other regions, they have different forms of capitalism. Europeans do it very differently. A lot of Asian state-run economies and emerging market economies do it very differently. So this is a very live debate. Now, those two things start to interact and have a big snowball cycle over the last few decades for a couple of reasons. You talked about buybacks, and buybacks have been obviously hugely in the news in the last couple of years, in part because they've reached record levels. But how did buybacks even come to be? If you go back to 1982, buybacks were actually illegal. They were considered market manipulation because if you think about what a buyback is, it's when a company comes onto the market and buys back its own shares, which artificially reduces the number of shares and drives up the share price. That was considered market manipulation. But under John Shad, who was the SEC director under Reagan, that was changed, and so companies were now allowed to do that. You start to see immediately at that point in the 80s a big uptick in the number of buybacks, and you also start to see the money within corporations being funneled much more into the financial markets via those buybacks, and you start to see the amount of R&D spending as a percentage of revenue, which would be another place that capital could go, start to taper off. Okay, so you come to the 90s then. Bill Clinton's in office. Bob Rubin is Treasury Secretary. You've got Larry Summers. You've got a bunch of kind of financially friendly folks in charge. And there is another debate that starts to happen in the 90s about wealth inequality and the financial markets and whether or not they're actually helping society in a productive way. And there were other folks in the Clinton administration like Joe Stiglitz at the time, the progressive, who were arguing, the wealth gap is getting really big here. And, we know financial markets have something to do about that. We see that there's a lot of corporate compensation that's being paid out in share options. That's an issue. And so Stiglitz and some others argued for a cap on corporate pay. But certain other factions in the administration, the kind of Rubin camp, argued, no, we should have a cap on corporate pay, but you should be able to have performance-based pay for top performers that would be paid out in share options. And so that was allowed above $1 million. And by the way, some of the folks, this was a very bipartisan issue because, not only were certain Democrats in favor of this, but a lot of Silicon Valley tech money, CEOs were lobbying for this because obviously a lot of their compensation was tied to share options. So that was passed, and you could now have this.
Which seems like a good idea, right?
Which seems like, no, none of this is like, nobody's being venal here. This is about trying out different things and seeing what they work, and seeing if they work. And, you can see the argument for paying someone in share options, absolutely. But what happens then, and if you look at the data in the book, you then get a huge uptick in the amount of share buybacks that are being done. You start to see huge amounts of options pay coming onto balance sheets, much of it, in tax favorable ways, which is a whole other thing that we may want to talk about, the tax code and how that plays into things. But you really start to see that performance-based pay taking off. You see wealth inequality starting to grow dramatically, and Thomas Piketty gets into some of this in his book "Capital in the 21st Century" and how stock options and performance pay figured into wealth inequality. That, of course, has I believe, a dampening effect on the overall economy because there's only so many cars and houses and pairs of jeans that rich people can buy. We can again talk about that. But what you really start to see then is that share options number goes way up, and investment into R&D as a percentage of revenue starts to go down. Now, I will say that actual causal links are very, very difficult to make in this equation, right? Because there's a lot of things, as you mentioned, the financial markets are a complicated place. There's a lot of things happening. But there are plenty of people and, academics, but also CEOs, folks in finance themselves that would say, a lot of the buyback money that's in the markets right now is going there because executives make these decisions. They get, 80% of their pay in share options. They have every reason to jack up the share price quarter on quarter. The street demands that they do that or they're out. The average tenure of a CEO is 3 years, and you have to be a founder, owner, an entrepreneur, somebody with a big personality to really fight against that pressure. And so you get this snowball cycle where I would argue that the markets are no longer effectively funneling capital to places where it is necessarily the most productive. They're funneling it to a place where it enriches this sort of closed loop of the financial markets itself.
Well, I don't think there's anything sinister. So I don't see it as particularly sinister.
Not sinister, it's incentives.
Yeah, I'm not sure how important the incentives are, but they're relevant, and it's certainly true that CEOs have an incentive to buy back stock rather than to give a dividend. But both of them are ways to return money to shareholders who choose. In the case of a dividend, everybody gets the money. Every shareholder gets the money. In case of a stock buyback, if you want to take the cash, you can then sell some of your shares and cash out and take a capital gain, which if it's a long-term gain is going to be the same tax consequences as a dividend. But to me, the bigger issue is why aren't they investing more? And that fundamental question is, of course, complicated. It depends on
not so complicated. One of the things I look at in my book, I have a lot on Apple because Apple is such a great mirror into this whole thing. Every time first of all, Apple hasn't needed to raise money for operating expenses since the 1990s. But every time in cash, every time that company, or frankly any company, says, you know what, we're going to make a big long-term R&D investment, the share price goes down. When they say, hey, we're going to do buybacks and dividend payments to, bolster the quarter, the share price goes up. It's really not that complicated. Short-termism rules.
Yeah, I'm not sure that's true. The reason I say that is that
it is true. No, it is. I actually documented in the book. It's well footnoted.
It's not necessarily the same as undeniably true. I think the question for Apple is Apple made a lot of investments, a huge amount of R&D investment over the last 25 years. Some of those were incredible. Lately, they haven't been doing so well, so their hit rate, their success rate is down. They seem to have lost some of their innovative mojo, so I'm not surprised that the market is not as enthusiastic about them as they once were.
Well, but if that kind of proves my point. The whole first chapter of my book is about how different the management of Apple was under Steve Jobs versus Tim Cook. You're absolutely right. This used to be a company that poured a tremendous amount of money into R&D. And, one of the reasons that they were able to do things like open Apple Store, open a giant glass box with 3 products in it. This is what Apple stores were when they first opened, right? If you if you'd been an average CEO, going out to the markets to say, hey, we're going to open a bunch of stores that, are incredibly expensive. We're going to put 3 products in them. All these things that Steve Jobs did. The markets were killing. But he was somebody that had the sort of force of personality to push those ideas through. Tim Cook is very much, I think, a steward of a more developed older company, and he works in a much more financialized way. And this is a big issue and problem. I mean, if you look, there's been some Stanford research that's been done on tech companies IPOing recently in the last 12 years or so. And you look at how their innovation starts to tail off after they go to the public markets. It's just really, really hard once you have that pressure of the public markets to jack up share price to say, we're going to do these 5, 7, 10-year investments in new technologies and sort of blue sky things that may not pay off, and they're going to be really risky. And we may even, lose market share or take a hit in the short term, but we think it's going to pay off longer term. I think it's really, really hard for companies to make those investments. And I think any CEO you talk to will say that that's true. And some of them want to, and some of them don't.
Well, they make those investments. They make those investments now in the early days of their company, spending their own money and the money of their venture capital investors who have a portfolio of 10, 20, 30 companies, of which they hope a few will become unicorns worth $1 billion market cap or more. And they realize that most of them won't. They can't know which ones they are in advance. And that's what that market does really well. And the stock market, the public company market, does something different. It's not surprising that it's hard to sustain brilliant innovation through the life cycle of a company. Apple's really an extraordinary story in that Steve Jobs was able to innovate more than once. Once is a huge number, but he was able to transform a number of industries through visionary investing. It's not in R&D. It's not surprising that Tim Cook can't do it. I don't think it's because Tim Cook has a different philosophy. I think Tim Cook's not as talented, and I say that with total respect for him. It's a tough standard to say you're not as talented as Steve Jobs.
Yeah, well, he has his strengths. But, I would say that one of the things that's concerning to me is that when you look at how who the new challenges are globally for big American companies, they tend to be emerging market giants or international competitors that don't have that same short-term market pressure. And I do think that makes a difference. I think that, family-run emerging market companies that can look out over 20, 30, 50-year horizons rather than 2-quarter horizons are able to do things that big American multinationals aren't. And given that those companies are still the largest employers in the U.S., I think that their operating environment is really important for all of us to understand. Yeah,
I agree with that. I think the deeper question, and I don't deny that there's some short-termism in U.S. companies. Part of it is the result of that short-term. What?
Some. I mean, I would say that that's the fundamental driver.
Well, would you say that's the driver in the political market as well? That politicians only care about 2 years, and because most representatives at most are two.
I think I would.
Risk of being thrown out. So
that's part of it. I mean, I have a whole chapter on the interaction between Wall Street and Washington. You might want to. We can get to that.
We'll get to that. No, that's the one we agree on totally. So we're gonna have fun with that one. I'm not. What's interesting, I think, for me as a reader of your book is that I agree with about half of it vehemently. With great. Right. Well, that's unusual. Ron, I'm a Chicago school economist, right? So I could disagree with all of it, but I don't. I agree with a lot of it, and I think it's a fascinating time in American public policy the last 5 years or so and going forward, where people like you and me who look at the world very differently agree very much on this one issue, which is that Wall Street has too much power and Wall Street has too much influence, and Wall Street can wreak a lot of destruction outside of its boundaries. And we agree on that, and yet we disagree on sometimes what the other stuff is, like we're doing now, about how the rest of the economy works, and we might disagree about how to make that better. And we'll get to the how to make it better part, because I think I think fundamentally there's a difference in our diagnosis of the problem, I suspect, as to why, even though we agree on that the symptoms are bad, we might disagree on the underlying disease. So let's turn to that. So one of the points you make in the book is how much credit has expanded in the United States to consumers, and that this has led to a lot of more profit for the financial sector, and you'd think it would go the other way. You'd think they would have to be competing to give consumers better deals. Talk about that and what's alarming about that, and what do you think is going on there?
Well, so this issue of debt is really important, and I look at it mainly in the tax chapter, because one of the things that I think we should be looking at, in Washington, is the way in which the tax code subsidizes debt. And it's actually an interesting question politically, because I know some conservatives who disagree with my analysis, but I know plenty of kind of Midwestern Rust Belt conservatives who actually do agree with the analysis and think that debt is a big problem. And one of the things that's fascinating to me politically is we talk a lot about national debt, but we don't talk so much about consumer and corporate debt, which, can wreak a lot of havoc. So a lot of the figures that I quote in this part of my book come from Sufyan Mian, who wrote House of Debt, which, you may have read, looking at how quick run-ups in debt of all kinds tends to be the biggest predictor of financial crises, right? And so I always like to, just as a financial journalist and somebody that covers business and economics, I like to look at where debt bubbles are brewing to look for where trouble may potentially occur. And sometimes it's difficult to see how the dominoes will fall, but you could certainly, in the run-up to 2008, look at the housing markets. And see debt run-ups there. I would argue that today you can look at the corporate debt markets and say that, okay, even though companies have a lot of cash on the balance sheets, some of it stored in overseas bank accounts, there's been a huge corporate debt bubble that's brewing. You've already started to see some correction of that in junk bonds, particularly in commodities markets. And what's interesting is a lot of those corrections that you've seen in the last 2 or 3 years have come when the Fed has indicated that, for example, it's going to pull back on quantitative easing, or that we're going to start moving into a different interest rate environment. That's when you started to see a correction in some emerging markets, in some commodities markets, and also the popping of certain junk bonds, particularly in minerals and manufacturing and things like that in the U.S., where you had seen a lot of run-up in debt. So debt has this perverse effect. Just as a little interesting side note, I'm thinking and looking a lot at debt in China right now, and I mentioned that a little bit in my book. I didn't get too much into it, but if you look at where there's been a huge run-up in debt in the last few years, it's been in China in a way that really makes the Arizona or Florida, housing markets seem kind of minor by comparison. So
yeah, they got some issues coming.
They got some issues. Yeah, now how they handle it and what a financial crisis in a state-run closed economy looks like is kind of another question. But so debt as a predictor of financial crises is important. And then the thing that I find concerning, and something that I wish policymakers would look more closely at, is how the U.S. tax code subsidizes that debt. So I'll just give a personal example. I mean, I live in a brownstone in Park Slope, Brooklyn, which is a very hot housing market. I, like every other person in the country, enjoy a sizable tax benefits from the mortgage interest deduction. That's a deduction that benefits mainly middle and upper class people.
Yep.
That is something, of course, that's a total political hot potato, but this is exactly the kind of deduction that I think we probably shouldn't be giving. I think that the housing market in my neighborhood and many others would look very different if we weren't getting that.
Totally
Same
agree.
thing goes. So same thing in commercial real estate, right? I mean, you can spread that out. There's also any numbers of ways in which we subsidize unproductive corporate debt. And, The Economist, you may have read, they did a really deep dive, I don't know, maybe a year ago, into this issue of tax code subsidizing debt versus equity, and what would it be like if that changed? And I'm not saying for a minute that that's not a complicated shift to make, or that wouldn't come with its own set of consequences that could have unintended implications. But it's an interesting question. Why are we subsidizing all this debt? Who is it benefiting? And, one party that it benefits a lot is the financial markets, because financial markets are intermediaries issuing the debt, making money from these transactions, and so on and so forth.
Yeah, I like to say that Republicans and Democrats are very similar. They both like to give money to their friends. They just have different friends. But they have one friend in common, which is the financial sector. So that's, I think, the most dangerous piece of our political economy and public policy incentives that we face today. But you raised the point about debt versus equity, I think, is a central question. And you talk about it in the book and focus on it correctly, that the rise in debt finance and the increase in leverage in Wall Street is just extraordinary. And I think you correctly identify one of the causes of it, which is an important cause, which is the end of the partnership model, which was the Wall Street model until really almost the late 90s, mid-90s. Until then, banks spent their own money. They were partnerships. You brought in your own money was at risk as a bank, as an investment bank. I want to make it clear, we're not talking about Main Street banks, talking about Wall Street banks. The investment banking business was very much a partnership model. That changed, and that to me is when we unleashed the most dangerous potential for disaster, which has culminated in the housing crisis. And that's because they weren't spending their own money. Their ability to borrow money got incredibly dangerous, which made them very prone to small changes in asset prices, making them insolvent, which is what happened. So for me, and I want to give you my explanation, you can react to it because you don't talk about it in the book. I mean, and I don't see a lot of people doing work on this, which is sad, which is, why did this change? Why did banks become publicly traded? Why did investment banks become publicly traded? My argument is that once it became clear that debt holders would be protected in bailouts, which started in 1984 with Continental Illinois, and then proceeded regularly through the Mexican crisis and elsewhere, that the people who lent money would be able to get almost 100 cents back on the dollar almost every time, that made it incredibly costly to be a partnership, because what you should be doing is being highly leveraged, borrowing a lot of money, going into the financial market through a publicly traded company, and having a lot more assets of other people to spend. So that's what, to me, is that big change. And so for me, and this is naive, but my goal is to reduce the applauding of bailouts. To me, bailouts are the source of our biggest problem.
Totally agree. No, I mean, I love this point, actually. And it's one of those really interesting points that I'm a liberal, but I'm a Midwestern liberal. My dad ran a manufacturing company. I kind of grew up with a somewhat different idea about debt and bailouts, I think, than many liberals have. And I agree with this point. I think that there is a tremendous amount of moral hazard at play here. And I, in my own research, didn't go so deep as you've just done to isolate particular cases and the legislation that led to all these changes. But I love this point. And what I did think a lot about is the way in which the political economy and Wall Street interact, and at the end of the day, it benefits a lot of people in Washington to have large financial institutions doing their bidding. And this is something that Calomiris and I forget the other academics that wrote Fragile by Design, got into, this idea that, governments from the dawn of time want financial markets to be big and rich so that they can do things like wage wars and build railroads and, whatever it is.
And donate money to political candidates.
Right. And that comes with all kinds of hazards. And then they have to end up bailing out these institutions that they have supported and kind of gotten into bed with. And it is a really, really perverse cycle. That said, I mean, and I'm curious what you would say to this, actually. I don't know what your position on the bailouts was. I think it was tough to take a completely Malthusian, argument, or Hayekian argument, however you want to, put it, that you should have just, let the financial markets completely collapse in 2008. I mean, what do you think about that?
Well, the problem is that once you head down that road, it's kind of like, to me, it's like saying to your kid, if you drink and drive, I'm gonna punish you.
Yeah.
And so the first time they do it, you say, well, you really weren't that drunk, and I'm not gonna punish you. And then, the 15th time, it's kind of too late. And that you get a wreck, you get a crash. And I've used this analogy many times on the program, and others have too. I think I invented it, but I'm not alone. Which is the forest fire. If you put out every fire because you're afraid it's going to lead to a forest fire, a bigger fire, eventually you allow the buildup of stuff that creates a fire you can't put out. And so we bailed out. A lot of the bailouts were justified. Going back to 1984, they were justified with, well, this could be a systemic crisis, so we bailed them out. Or what you talk about long-term capital management, at least they were bailed out with their own, Wall Street had to use its own money, but they were coerced by, as you point out, by the Fed to do that. And so each time there was what probably would have been an unpleasant but not earth-shaking disaster, we made sure that everybody was given a do-over. And that eventually created a disaster that was so large, there really would have probably been a horrible conflagration, a horrible disaster. And so everybody felt pretty good. And in my profession has almost unanimously, I'm the exception and a few others, but almost unanimously applauded the 2008, 2009 bailouts as necessary. And, well, they kind of were in that they probably would have been a much worse recession, maybe a real depression at that point. But we sowed those seeds so long ago. Yeah. And so the real challenge now is, well, now what? We've created a concentrated banking system that's prone to a much bigger problem now and that is going to easily say, oh, you can't let us just die because there's going to be horrible consequences. So I just feel like we boxed ourselves in a terrible way.
I think that's a really deep and important point. I mean, as you were speaking, I was thinking about all the factors that go into this. I mean, when you think about how officials and regulators react to the markets, I mean, I was thinking about what's the difference between, say, a Bill McDonough, as New York Fed chair versus Tim Geithner. I mean, they're
not much.
Well, I don't know. I mean, McDonough, I think, might have been maybe was a little tougher at certain points. I think that there's a way in which maybe because the rise of finance has now led to such a revolving door between the institutions and Treasury and the Fed that there's a group of people that are, I think, perhaps less likely to personally push against the institutions at crucial times.
Oh, absolutely.
What's that, sorry? Yeah. So you get, I mean, at the end of the day, how does this stuff work? A crisis happens, you get everybody in a room and you say, you know what, guys, you're going to put your own capital up. And you can say that in a way that makes them know that there's 10,000 levers you can use to make their lives hell if they don't. Or you can say, or you can blink, and why does that happen? But then there's this much, much deeper issue that you're hitting on, which is that, yes, there are personalities and there are the particulars of the moment, but we've been brewing this problem for decades. And how do you fix that? And, one of the things that I talk about in my book, I really, really don't like certain aspects of Dodd-Frank as much as I think the financial markets need to be properly regulated. I don't like the way in which we're going back and trying to post facto predict, how to prevent X, Y, and Z type of crises, because as we know, the next one will always be different and it will come from a different place. And that's why I think we need a fundamental rethink of what does a healthy financial system look like? We need, and by the way, we need a healthy the financial markets are so important. I feel like this is part of this debate that doesn't really get spoken about so much. It's always, and this is something I tried not to do in my book, and maybe I failed, but I really didn't want this to be a banker bashing book. I mean, the financial markets are the center of the capitalist system. They've got to be healthy. They've got to work properly. So what do we want them to do? And then how do we incentivize them to do those things rather than post facto trying to prevent every possible bad thing that they've ever done from happening again, which isn't going to help us with the next crisis.
Yeah, and Dodd-Frank, I mean, it's I haven't read it.
Which you haven't read 2,000 pages?
I've read a lot of pages of a lot of things that I didn't want to read. So I confess this with some shame. I should have read it, but in a sense, one doesn't have to read it. Here's why. So let me make this claim and let you react to it. What's clear to me about Dodd-Frank not having read it is it's, one, extremely complicated. It puts a lot of compliance burden on banks, and the bankers, I don't know many bankers, I know a handful, who I interact with very casually in social settings now and then, and they all tell me that their world has gotten more onerous. There are more people around keeping an eye on them, which could be a good thing. But they're obviously not going to like that. It's not surprising. So Dodd-Frank raised the regulatory burden on banks. Everybody who has read it tells me it didn't solve the too big to fail problem. And I know that's true because we'd solved too big to fail before, and we didn't use those methods when the crisis came because it was politically unpalatable to do that.
And it still is.
And it still is. So here's what I see, and tell me if you think this is too pessimistic. This is probably, again, where we might agree. We've made the regulatory framework more Byzantine, more labyrinthine, with the result that only the biggest banks find it easy to comply because they can spread those compliance costs. They give a whole part of their bank devoted to Dodd-Frank. Smaller banks can't do that. So what we've done is we've made the banking industry more concentrated, which means that their claims for the ease with which they'll demand a bailout goes up because they're more systemically, each one of them is more systemically important. They're more concentrated. And I just see this as the next forest fire is going to be even bigger than the last one, and the consequences will be worse. And, my goal, which is this is the naive, quixotic part, my goal is to make it politically difficult for politicians to make those kind of bailouts. I want people to see behind what really happened and have the outrage and make it culturally difficult to do these things that I think are the part of the problem. I don't know another way. I don't think we're getting there.
I don't think we're getting there. I mean, I think that these are great points. And I would agree with I'd agree with, largely everything you said. I do think it's factual that the biggest institutions have gotten bigger, which by proxy, I agree, means that it will be easier for them to demand a bailout if there is a crisis. It will be harder or as hard as it was for politicians to stand up to that. There's nothing in the legislation that explicitly prevents bailouts. It comes down to political will. I didn't see anything in Dodd-Frank that made me think that it was, that we'd solved the too big to fail problem. Dodd-Frank was incredibly complicated, though, right? I mean, it was spliced and diced not only by political factions, but by the bank lobby itself.
Always. And,
one of the author's note to my book, which I'll just mention because it was kind of the come to Jesus moment when I realized I had to write this book. I was sitting in an off the record meeting with a former Obama administration official that was sort of trying to tie a bow around the administration's handling of the financial crisis and kind of be like, okay, we're all done, nothing to see here, move along, folks. And Dodd-Frank at that time, it was 2013, and it was only maybe 50, 60% written. And I was looking into why that was, and I had found some academic research. Showing that.
Shocking.
Well, I mean, it also goes to the point of a complexity, like, hello,
Yeah.
But I'd found some, there was this academic from University of Michigan doing God's work who tallied up all the public consultation meetings that had been taken on the Volcker Rule, which was, the rule that was going to separate commercial lending from trading, and it was one of the most contentious parts of the legislation. They found that 93% of those meetings had been taken with the largest banks, many of them with, just a couple of institutions like JP, some of them with Jamie Dimon himself. It was just this very, very concentrated group of voices in the room at the time. And this official was arguing that, well, we'd gotten done everything we needed to get done. And, lobbying pressure was not a factor here. And I raised my hand and said, well, how can you say that when 93% of the voices in the room were the people that are being regulated? And he looked at me with true bafflement and said, well, who else should we have been talking to? And that was the moment where I looked around. It was really interesting, too. This is an important point. This was a group mainly of financial beat reporters. There was only a couple of generalists like myself there. And I thought, oh my God, everybody's going to be scribbling, right? This is going to be the hot thing that happened in this interview. Everybody was just kind of going along because the cognitive capture.
I was going to say, even journalists can have cognitive capture, can be suffer from
we're the worst, I mean, we can have a whole other podcast on what journalism does wrong, but I was just like, wow. I'm not saying when you build a bridge that you don't need a lot of civil engineers around, but you need some people that are going to be on the bridge too, No,
it's an incredible problem, partly because, as you point out, the people inside the bubble have been inside the bubble so long, and more importantly to me, profit from the internal echo chamber that it doesn't even cross their mind. It's not like. Right. Again, it's not something sinister. They're not sitting around thinking, how can we? No. My version of this is Hank Paulson. I think I'm going to forget these numbers, but Paulson talked to Lloyd Blankfein of Goldman Sachs, I think 24 times in a 2-week period in the middle of the crisis. And my joke was, well, they weren't talking about their kids' summer vacations, they were, right? And obviously, if I were the Secretary of the Treasury, you'd want to talk to somebody at Goldman Sachs about what they thought was going on. They probably do have a lot of inside useful information one would take into account. And I don't want to minimize the challenge, by the way, of being in that position. I don't, I'm very aware that it's easy for me to take pot shots at people under tremendous pressure. And couldn't they have done 99 cents on the dollar on some of those? So the fact that no one took a haircut other than I think one, I want to say, is it Washington Mutual? I can't remember. Everyone else just got all their money back, and everybody got to stay in their jobs too. They could have removed people and said, "Okay, we're going to bail out all your creditors, and they're all going to get 100 cents back on the dollar, but you can't do what you're doing anymore." And I just want to raise this. I just want to raise this because I think it's really important. You were very critical of Chicago School economics for a couple paragraphs in your book, and where I agree with you on that, and I wouldn't say it's literally Chicago School economists, but so-called free market types who say, well, that would be wrong to remove people because that's not capitalism. The government shouldn't be able to remove people from their job, and I agree with that. But once you say the government can then force people to be compensated for risks they took and messed up on and get their money back anyway, you're in a different world. Right. You can't. Well, that's the worst of both worlds.
I think that's a hugely important point, and it's something that's not well understood is that free markets have to be free markets. But what we have now is not something that Adam Smith would have recognized as a free market. I mean, Adam Smith would say you need 3 or 4 things for a market to be well functioning. You need price transparency. You need equal terms for folks on both sides of a trade. He would have argued even that you need a kind of a shared moral and societal framework, which is very, very interesting. For markets to function properly, because that's not what we have in this country. And I think that the point that you mentioned, the sense that the entire public had that, hey, something's rigged here. Well, we wonder why. We have the election cycle that we did, and we wonder why Donald Trump is president, and we wonder why populism is raging in any number of countries.
And why
this is it, folks.
An aging socialist almost defeated a real socialist, right? Not just a left of center person, but a socialist almost got the Democratic Party nomination, is because people have a sense that something's rotten, and they're right. Something is rotten.
And they're right. That's right. And I think that it's interesting to me because when I look at the 2016 election, I think that that's what people were responding to. And I worried, so much about Hillary Clinton's campaign because of that. People were responding emotionally. They were not responding to the particulars of any facts. And just listening to Bernie Sanders talk about the financial markets, I would just be like, roll my eyes. But he and Trump both were capturing this visceral, felt experience that people out there know. You don't have to know anything about Tier 1 capital to know that something's rotten, as you say.
And as you point out, the fact that homeowners didn't get a bailout is not a coincidence. It's not like no one thought of it. They just, for a whole bunch of reasons, it wasn't politically as attractive as bailing out the funders.
I think it's going to be really interesting, just to talk about the current political milieu for a moment, I think it's going to be really interesting to see how all this plays out for the Trump administration because, one of the things that happened with Obama, I think one of the reasons that he hit so much that he wanted to do was derailed is because he didn't do the right thing, on the financial crisis at the very beginning. Now, we've talked for an hour about why this is complicated and hard, but the bottom line is the homeowners didn't get a bailout. Wall Street did. People knew something was rotten. And then not only did any kind of coalition on the left break apart, but you sort of lost the goodwill of middle America in a lot of ways. Yeah. Now, I think it's going to be really interesting to see what happens in this score with the Trump administration. It's somewhat different dynamics politically, but is Wall Street going to get a break? Are people going to, and, we may be coming to another financial crisis or a downturn sooner than we think. Trump's definitely unleashing animal spirits in some ways, but he's going to be fighting policy against the Fed. And there's all kinds of international dynamics that may play into this. We're really at the end of a recovery cycle where, we're 8 years now. Almost 8 years. And that's when recoveries usually end. So
they usually end a lot sooner. This has been a very unexciting but long recovery that we're in uncharted territory. It's my view is my listeners want to hear I think about trade issues at some point. I keep promising we'll get to it, but Trump has
another exciting podcast.
Trump has unleashed some positive animal spirits and some really negative ones for me on trade. I have no idea where we're going to end up, and he's got a lot of. We'll see. Let's talk. We got a few minutes left. Let's talk about what you might see. Let's get out of the weeds because Dodd-Frank is. Part of the problem with Dodd-Frank for me is what you pointed out, that even in 2013 it was, would you say, 50 to 60% completed. Yeah. That to me is death to a democracy. To say that we passed this big law to fix this big problem, but we're not sure. We're not sure what's in it. We're going to write what's in it as we go forward in ways you'll never notice because you won't be paying attention anymore. That's to me just not a good thing, and that's part of the administrative state that I think is really another part of our problem. And I would add, just to come back to what we talked about before, for me, a lot of the uncertainty about regulatory detail and specifics is part of the reason that investment in America in real things is not so healthy. But that's, we could debate that. It's not an open and shut issue. Obviously, it's just it's a speculation. But stepping back from the details, what would you like to see as the short-termism that you decry? Like, how do you fix that? You'd have to understand why it's there. I don't understand why it's there. I am somewhat skeptical, and you think it's obvious. But if you want to change that, if you want to give more of are you thinking about cultural change? At one point, you talk about MBA education being part of our problem. Yeah. It's very hard to change. That ain't going to change tomorrow. What do you see as ways to maybe make things a little bit better?
Well, so sadly, on the short-termism problem, I don't think that there's one silver bullet. I think that there's a few things. We talked a little bit about buybacks and the legislation around those. I know liberals and conservatives that would like to see us take a look at that 82 and 1990s regulation and say, is that serving people? Is that serving the markets? Is that serving the overall American economy to allow the financial markets to operate in this way? So that would be one thing. Culturally, definitely business education, I think, has become focused a lot on balance sheet manipulation. And that's something that a lot of CEOs that I talk to have a problem with, because it means that they can't find folks that are actually thinking about business and growth in a more holistic way. They're tending to come out and just look at P&Ls and how do you cut costs? How do you marshal your capital? Well, we're actually living in a world with plenty of capital. Central banks have dumped $30 trillion of money into the markets globally in the last few years. So there's plenty of capital. Talent and workers and consumers, I think, are where the action is. And I do feel that, we haven't even talked about technology, but it has a huge intersecting effect here. Not only did technology speed up all the processes of financialization that we've been talking about, but Giant tech companies in general are in some ways the new too big to fail systemically important institutions. They're underwriting bond offerings the way Goldman Sachs would, but guess what? They're not regulated like Goldman Sachs. And they're developing all these technologies that are changing the labor markets quickly and in profound ways that may affect underlying GDP growth and consumer demand. All this is to say you need business executives that understand all of that and can think holistically rather than just saying cut costs, marshal capital. And then there's also this broader question that we touched on about what are the financial markets for? I would go back to Adam Smith and say the financial markets are there to support the real economy. And how do we simplify regulation? And, this is total wishful thinking, but if the Trump administration and the Republicans do throw out Dodd-Frank, there would be a golden opportunity, and I'm not particularly hopeful because of all the lobbying pressures we spoke about that it would be taken, but there would be a golden opportunity to rethink regulation from the ground up and say, what kind of a financial system do we want to have? Let's look at what banks and financial institutions are doing that we know is good for the real economy, and let's incentivize that and really try and flip the paradigm on its head. Start with what banks should be doing rather than trying to come up with 2,000 pages of what they shouldn't be and all sorts of loopholes that are going to enrich any number of white shoe law firms.
Yeah, I want to see firms take risks and be rewarded when they succeed and punished when they fail. And it seems that part seems kind of simple. I don't know why. Well, I guess I do know why that's not enough. But when I look at, say, you mentioned Silicon Valley, a lot of Silicon Valley companies, which have very high market valuation, may have a bankrupt business model despite their valuation. And Uber is an interesting example. Some people say they're really not going to make it. It's just a pipe dream. They're really betting on the driverless car possibility. That's going to be a very crowded segment. It may not succeed. And let's say they disappear. Oh, that'd be good and bad. Good for some people, bad for others, and there'd be some other remaining competitors. Maybe the whole business model dies out, and that'd be the end of it. It wouldn't destroy the American economy if the venture capital firms of Silicon Valley, which are very special in that they create this stew of new opportunity that's very unusual compared to the rest of the world. If they were to disappear or make a series of really bad investments, one of them, and they went to Washington and said, we did really badly, we want our money back, we'd all say, we'd laugh at them.
I like your baby voice, right? Russ.
So that should be the mode. And I don't know why we can't think that Wall Street should be more like venture capital firms. I want to let them rise and fall on their own successes and failures and not on mine. I want my wallet out of the equation. And I just want to add, because I didn't get to pile on. I want to pile on. My colleagues in economics, I think, too many of them are the handmaidens of Wall Street, or the handmen. I don't know what the right phrase is, but have been the facilitators.
Not too many.
We've been the facilitators of this evil symbiotic relationship between Washington and the financial sector, and we should be more skeptical about its overall value. And of course, we are, as Luigi Zingali's, you mentioned him a few times in your book. We've interviewed him here. He points out that we've got our own special interest. We're compromised as objective observers. Many of us are. I'm not, fortunately, but many, or unfortunately, depending on who you talk to. But I just think we need to be more blunt and try to get out of that cognitive capture experience and try to concede the fact that the world is not working the way we sometimes claim it is.
Yeah, absolutely. Skepticism about the models is always a healthy thing, I think.
My guest today has been Rana Foroohar. Her book is Makers and Takers. Rana, thanks for being part of EconTalk.
Thank you.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.